Oh, sorry, so it's preparing notes. Hello, everyone. Thank you for joining this panel discussion co-hosted by the International Growth Center and VoxDev. We're joined by a really cool set of people from across the world, from London, Oxford, Addis, Lusaka, who come from different perspectives, from policymaker, from multilateral institutions, from DFI and academia. So we're going to hear really interesting perspectives about this really important question today. To all the panelists, can you keep yourself mute unless you're speaking, and keep your videos turned on. So we're going to have a very interactive session today. So I strongly, vehemently plead to everyone in the audience to ask questions so I don't have to ask questions. So please use the chat box below as the conversation goes along. You can also vote on other people's questions. And as a true Democrat, people who get the most votes will get priority responses over the next 70 odd minutes. I don't want to spend too much time sort of preaching to the converted, given everyone who signed up here already would know what critical minerals are and why they're important. We hear a lot about lithium, cobalt, copper, and how critical they are to the global energy transition. But we also know at the same time that their extraction and refining remains highly concentrated in a few countries, more refining than extraction. And they often come with significant environmental and social cost, and too rarely do they translate into lasting development for producer nations, particularly for Africa. And I want to focus on Africa in this discussion because it holds a unique position in this debate. Now, depending on who you listen to, because critical minerals, some minerals are more critical for other people, and they usually tend to be critical for the consumers of those minerals. But Africa, in most accounts for about a third of the world's reserves of what are often described as transition critical minerals. But most African countries capture only a fraction of the value. Zambia, and we have Kuso, my friend, joining from the Presidential Delivery Unit, refines less than 2% of the copper domestically while being one of the largest producers of copper in the continent. Just across the border, DRC refines about 7%. So there's a lot of extra value which is left on the table in a manner of speaking. And that's the starting proposition for this panel today. How can African countries transform their natural mineral endowments into sustainable economic opportunities rather than just raw exports? What would it take for global partnerships to move beyond transactional trade towards deeper and more transformative cooperation? And what reforms in institutions, infrastructures, and incentives are needed to turn that vision into results? So the panel will be structured as follow. I'm going to ask the first question to each panelist. They will have about 3 odd minutes to respond, and then we will come to a second round of questions, but might integrate audience questions in that round. And then we will open it up entirely to the audience questions in the chat box. So again, please ask questions. I want to start with you, Amir. For those who are not familiar with the work, which would be very few people, you're an associate professor of political economy of development at the University of Oxford, where you're also the director of the Technology and Industrialisation for Development Center, and have written very widely on critical minerals. Amir, do you want to, help us sort of set the stage a bit and take a few steps back? We hear a lot about that the critical minerals are the new oil. They're, strategic, contested, they're central to decarbonization agenda. But from your vantage point, what's the real opportunity for African economies here? And what are the biggest challenges and risks if we get this wrong?
Hello, hi everyone. Greetings from Algiers. So, yeah, first of all, the topic is of extreme importance. So, thank you for setting up this dialogue, and hopefully, it will lead to more discussions. Um, my take might not be conventional, but I do not think that critical minerals represent a great opportunity for Africa for several reasons. One is we know why they're important. We know how they can be used, for economic upgrading, but we rarely ask ourselves, who are they critical to? And I think we really have to unpack this notion of criticality, right? Which is highly dynamic across time and space. What is critical today, right, as a resource might not be critical tomorrow. What's critical for the DRC or Algeria or South Africa might not be critical to Finland and vice versa. So there is a danger here, right, in the assumption that this is Africa's entry door to the green economy and to green value chains. Because if you even look at the practice, in terms of which countries in the global south have really managed to gain strong comparative advantages in low carbon value chains, you see that it's rarely because of their natural resources, right? But it's because of their pre-existing technological and productive capabilities. Malaysia is the second largest exporter of solar cells in the world. It has nothing to do with its natural resources. It's because it had managed to build a strong electronics industry, right, with technological linkages for solar cell production. Brazil is a huge manufacturer of wind turbines, but it's because of its pre-existing aerospace engineering skills, right, and sector. And one of the risks with sticking to this idea is just about the critical minerals is that we tend to forget all the wide range of opportunities for green industrialization on the continent that don't depend on natural resources. The second risk is technological disruption. Green technologies, we are at the height of the learning curve for some of them, but we expect more and more disruptions, which is normal. It's good. But what will happen to batteries, right? Now, lithium, cobalt are needed for batteries. In 5 years, 10 years, if it's solid state batteries that actually if they become the most competitive, that don't use any lithium, what's going to happen to countries that export lithium? If it's hydrogen-based batteries, right? If cobalt suddenly is not needed for consumer electronics, the DRC will remain with the short end of the stick. So this is why, if they represent an opportunity, I would, in my opening remark, strongly focus or urge on the need to focus on technological foresight capabilities to really understand what is the future of those minerals, how long can they be expected to be critical, and if they are to be extracted, they need to be critical for the country. Because let's not forget, many regions of the world have critical resources. Europe, Scandinavia, Sweden, Canada. How come it's only in the African context that suddenly those have to be the engine of growth and not in other regions? So I'll stop there, and I look forward to the rest of the discussion.
That's great, Amir, and this good start and sort of counter the status quo often on how we have these debates. I have a lot of follow-up questions to you, but I'm going to come back to on that and also
I'm not
recycle.
being nuanced. I'm being really one-sided because I know we'll have a nice dialogue.
Yeah, that's good. Let's have like teams and compete, but also recycling and other things. Would love your thoughts about that and how technological disruption might affect that. Marit, I think this is a great time for you to come in with a couple of introductory remarks. Those of you who don't know you, you are currently at the UN Economic Commission for Africa, but until very recently, you were the interim director for the African Minerals Development Center, AMDC, at the African Union, and it's a really important body at the AU to coordinate a lot of these cross-country strategies on the continent. Now, Marit, I was counting, there was like amount of visions and policies and dialogues on critical minerals in Africa, and there's a lot, right? So the African Mining Vision, I think 2009 was when it came out, the African Green Mineral Strategy, there's mineral codes, Pan-African, which are now updated and regularly published. There's a lot, and the aim seems to be to increase value capture, to increase regional initiatives and integration and cooperation on this. I want also you to reflect on what Amir was saying here, but also speak a bit about the regional initiatives and continental initiatives, which are truly positioned to shift the status quo and get wherever possible for African countries to capture more value addition, to expand mineral bases and outputs. So on that, Marit, over to you.
Thank you very much for having me and for this interesting discussion. And it even started very interestingly by the comments from Amir, which I appreciate because it's always good to debate. But of course, the Africa Mining Vision 16 years ago, 2009, realization that Africa was not benefiting it was not critical at the time, it was just any minerals. And there was a commodity price boom back then, and Africa was not benefiting. 16 years on, I'm not going to say it's gloom and bloom because, at the end of the day, the 20 most producing countries in Africa have amended their mining codes, their mineral policies. They have reformed a lot of the 20 most producing ones, at least. So, I mean, there's a realization of realignment of course, the end goal is to create value on the continent. And the surest way to Amir's point, the surest way to get value out of these minerals is to add value on the continent, value addition, resource-based industrialization through regional integration, etc. So because there is, when you look at the whole value chain, there's of course the revenue side, but we know that, there's always the illicit financial flows, transfer pricing, revenue is not optimized. Of course, what you can get some of it from just the revenue side and taxation and the fiscal regimes, but you do not get the maximum. So that's the realization of that the AMV was born in 2009. And now we have the Africa Green Mineral Strategy. And I'm glad you talked about criticality, Amir, because we defined it very differently. We called it African Green Mineral Strategy because we say critical to who exactly. So we defined it very specifically for green. For us, green minerals are feedstock into clean energy technologies, green industries, and into mining supply chains and equitable industrialization to serve Africa's needs. So it's clear we're not talking about the ones that are used for defense or for other purposes. It's green. They overlap mainly with we talk about the lithium, cobalt, graphite, manganese, and all others. But we want to make sure that we are the solution to the green industry, not for any other purpose. So when you are purposeful like this, that's when you can really think of having some kind of impact. And so you talked about concrete initiatives. That one that I'm talking, there is one that is everyone is talking about because we were also part of it. So I'm kind of proud of it. Is the Democratic Republic of Congo and Zambia Specialized Economic Zone for batteries, for precursors. It all started with a Bloomberg study that was commissioned by African institutions, UNECA, Afreximbank, African Development Bank, etc. And then in that finding, they found that there is cost and emissions. The emissions part was clear because, as you know, usually it's the refining and the value adding is done in China. Definitely there will be emissions when you transport all of these. But there's cost advantage of having a precursor in the DRC, and costs and emissions advantage. But of course, it requires the infrastructure, the skills, the technology. You mentioned technology. Technology is very important. And for that, and of course, capital with a big C, it's very capital intensive. So, but that finding that there is cost and emissions, that's when it's the launch of this DRC Zambia project. There's an MOU now with the US and also with others. We're still going, off-takers are not, coming, they're not running because of so many perceived risk, real and perceived risk, but it's there. What I'm saying is that it's not all gloom and gloom. So I don't know if you asked it, but I know you were going to ask why we're not making such headways, because we're fragmented. We're not really thinking in Africa as blocks, as Africa one voice. If you have, for instance, negotiating a SADC instead of just DRC, Zambia alone, or Zimbabwe alone, because Zimbabwe has lithium and Mozambique has graphite, and everyone can come together, but there's no industrial regional hub going on. And that is elusive. And when we talk about this with a lot of governments, and I'm glad Zambia is there, I mean, there's a realization that we need to be regional, but it's not really happening at the SADC level, for example, the South African Development Community level. There is an attempt of harmonizing policies, but it's not really there. So regional integration is a bit elusive. Regionalization, mineral corridors is also one we always talk about, but it's elusive. So the point is that we know what is done, but we need very deliberate at country level, but also at sub-regional level, deliberate policies, institutional coordination. And then, of course, that's when you attract even the investments that are responsible, so to speak. I don't want to go into that debate of responsible now, but the responsible ones and the ones that are really meant for this. So I am, unlike Amir, I believe there is a future in this, and we do foresighting. We do foresighting because we know the time is very limited, because cobalt they can find an alternative for cobalt, for example, or technology changes. But within those timeframes, if you really are deliberate and plan and have a roadmap and have a foresight and have deliberate policies, then you can make headways. I'll stop here and hopefully we can have conversation later. Thank you.
All right, this is all great. And I'm going to call and ask you about perceived risk and real risk and how that gap can be narrowed, especially on the African continent. But Marit, just a quick, I'm going to be unfair here, but a quick follow-up on what you're just saying about, regional blocks, integration of policies and action is, quite limited. Why is it limited though? Is it just political will? Is it changing incentives? Is the coordination cost just too high?
I wish I could give you a simple answer. It's complicated. We do have the Africa Continental Free Trade Agreement, which could, even for mineral corridors, we could be the anchor for that. But there's harmonization of policies has been very difficult. Even some of the policies that are, for example, free movement of people, because goods cannot travel on their own, it has not been pushing. And there's a lot of factors that are, deliberate. What I'm saying is you need deliberate kind of and policies and governance issues that are clearly there. You need champions, basically. We're looking for champions at the regional level so they can pull a critical mass of 2, 3 at the presidential level, because we know the ministries, and I'm glad Zambia is there. Maybe she can elaborate at the country level, but we know who they are at the country level, but we need the pushers from a regional level that can make the impetus. But there are, like I said, institutional infrastructure, of course, physical infrastructure that is, I don't know if for example, there's a Lobito corridor, which is a great, but again, we risk exporting raw materials if you're not organized and we're not putting our acts together to make it for value addition. Thank you.
Thank you, Marit. I think that's a great point to come to Kuso on a slightly hot seat right now. So those who don't know, my friend Kuso, and also IGC's longstanding friend, Kuso is the head of the Presidential Delivery Unit in Lusaka at the President's Office in Zambia, and was until very recently also Permit Secretary at the Cabinet Office. Kuso, I think there's a lot of, so you're the only one here with a country level, high level policy perspective. Zambia is one of the countries in Africa which have a lot of this transaction critical minerals, particularly copper, but there might be other stuff as the geological survey is ongoing. There's a lot of discussion in Lusaka, as you know, about adding more value at home. Lobito corridor is mentioned a lot. There's a lot of conversation that we shouldn't be just digging and exporting minerals. Also, that's a big part of the strategy. What other reforms sitting in Lusaka the government of Zambia is doing? And also perhaps building upon what Marit was saying, what other things should the regional and cross-country continental blocks should be doing to support those initiatives to add greater local value addition?
Thank you very much, Shah. Can you hear me? I hope my sound is okay. Yeah. Thanks for having me. And I think being the only government person here, I guess I'll be limited because everybody else speak their mind. But I'll try as much as possible to be objective. I think you are right in saying that there's a limited, value addition happening at the moment. Zambia is the second largest copper producer in Africa, and I think number 9 in the world. But however, we find ourselves exporting most of our copper and other critical minerals raw because of the capacity challenges that we have in terms of the downstream activities. So firstly, I think what we have done in terms of reform is starting with our chief marketing officer, which is our president. And I agree with Marit that you can see the efforts we're making as nations, but we need a bigger push as a continent to work together. And of course, he has tried to bring our colleagues on board. For example, on the EV battery precursor, we are trying to work with the Congo DR and our partners and our neighbors to see how we can come together to create value together. But of course, that's not a very easy conversation that we can have. But we are riding on 4 key principles when it comes to critical minerals as a country. And these are our president's, principles, and we're applying them in most of the work that we're doing regarding critical minerals. And the first one is for us to be able to get low cost of capital. because that's the biggest challenge. How do you access capital, and it must be affordable capital? That's the first thing. So the de-risking issues, the credit, sovereign debt issues that we have, we're trying to see how we can find solutions to be able to access cheaper capital in order for us to capacitate our downstream activities. Secondly, we are looking at advanced skills and technology transfer, because mineral wealth is useless if you don't have the science to extract it and to process it. And then thirdly, we are looking, of course, heavily at local value addition. And on this one, there are some efforts, a few investment opportunities that have been packaged specifically to support this particular one. I'll speak a little on that later. And then fourthly, we are looking for partnerships of equals. And that's basically looking for a win-win, equity participation for our locals. In Zambia right now, we have over 80% of the mining licenses owned by Zambians. And I'll give you an example of emeralds, where we have about 86% local license holders. However, the active mines are usually the foreign-owned ones, because the foreigners have access to capital. So what can we do as a country, first of all, to enable the Zambian mines to be operational, but also secondly, to enable some refining and manufacturing downstream to go ahead? So based on this, of course, we've come up with a number of deliberate policies, which include, firstly, to look at the associated infrastructure that is required for this to even be made possible. So we're looking at road, transport, logistics, and all that, including energy. We have a target of 3 million metric tons of copper by 2030, which is tripling our current production. And that cannot happen without the required energy. So we are doing a lot of reforms in the energy sector to make us have sufficient energy. We are also doing a lot of reforms in the transport sector, which includes the Lobito Corridor project that we have now. For Lobito Corridor project, we've packaged some investment opportunities, which include processing, refining plants, and all that is all available in that particular package that we're doing. And we'll be having an investment forum to explore this further very soon. But yeah, to cut the long story short, we're just trying to see how we can, increase investments in, copper rod, wire and cable, value addition. We're looking at increasing our smeltering and refining capacity, and there are specific investments that are available for this. So mostly as government, our role is to create a conducive environment for businesses to thrive. So what we are doing as government is to try to have these conversations, especially on behalf of the locals who don't even have the opportunity to be in a room with investors. So as government, we are facilitating such conversations. And I think for me, that's the biggest reform that we have done so far. There are some very promising projects, which I can share once I'm allowed to. But I think in the next few months, you should see a big difference, and you should see a lot more happening in terms of value addition locally.
Thank you so much, Kitaw. I'm going to come back to sort of unpacking that in a minute about what do you think is working well and what isn't on the sort of various different policies. But I think Colin, again, is a managing director of the British International Investment, BII, UK's sort of top DFI. There's a lot of now conversation by Marit and Kusobile about capital and both sort of risks taken, associated infrastructure, which needs to be built to allow for the opportunity for whatever it might be worth, as Amir sort of alluded to it, to be able to, take advantage of it. So DFIs like BII are, expected to take some of these risks, which other financiers and investors wouldn't. What makes certain critical minerals projects worth backing, both for economic returns, but also developmental returns? And also, if you can sort of give a bit of an overview about what have you and BII perhaps learned about real and perceived risks working in, let's say, fragile countries like DRC, which might be really mineral rich. Is there sort of some learnings from you which you could share on that?
Yeah, those are two very different questions. let me take the first one, which is in fact a deceptively simple question when you consider critical minerals. And the reason it's deceptive is because in the area of critical minerals, we are not only trying to balance commercial sense and development impact, but we're also adding in this kind of notion of supply chain security, which is emblematic of a sort of a shift of development finance to begin to entertain non-traditional development objectives. And I will speak on behalf of sort of all DFIs, but on this issue, they're highly varied. Okay. So what makes a good investment in critical minerals? Well, I mean, commercially, from a high level, they should make commercial sense. I mean, that's sort of implicit in the term critical, that there's a scarcity here and that people are willing to pay for it. However, when you start looking at it, the commerciality of some of these investments are a little challenged. They are difficult to mine. They generally are being mined in very low yield environments. If you move, as Marit and Kusobile talk about, downstream, then it is very difficult to compete with China on refining, which is why you end up in these weird worlds where the United States, for example, extracts minerals and then sends them to China to be refined. But obviously you can try and manipulate through tariffs and industrial policy to enhance the commercial attractiveness of some of these assets, some of these aspects of either the extraction or the refining. And obviously, once you get truly downstream and you're starting to make magnets or applications, I think the commerciality sort of stands on its own. But the real issue for DFIs, I think, is the development impact side of it. And let's just go down the sort of the pathway. I mean, if you start with extraction, extraction has perhaps the highest security value and perhaps the lowest development impact for the country, because extraction is traditionally a low productivity enterprise, as we all know. That's even before you start to talk about E&S issues and governance issues and so forth. So if you move down the step and you then get to refining, I mean, refining is more productive, but perhaps can be described as productive only in comparison with how non-productive extraction is. I mean, we should not, a lot of this refining today is, highly automated. So even there, you have productivity challenges. But I think it's difficult for refining to compete commercially. And now you start getting into some of these security issues, which we'll come back to, because certain countries would take the position that they're not entirely happy with the refining and the production happening outside of their country. That's the entire security issue. So here we begin to have kind of the beginnings of these particular tensions between this security concept and development impact. So then you move broader and you get to supporting infrastructure. And I think here clearly we are in perhaps the sweet spot for DFIs, which is in order to enable extraction or refining and processing, you need energy, you need logistics. Why this area is attractive to DFIs is not only do you directly enable the extraction, but you have a host of spillover effects and broader systems effects. I mean, if you are creating a railway like the Lapido corridor, anyone can use the railway. If you're enhancing energy that goes onto the grid, there's knock-on effects there as well. If instead you're using renewable energy, you've got climate change. So that's why you hear so much about the supporting infrastructure. And I can talk a little bit more about that later. But it's worth talking again about these kind of security interests, because as I speak to DFI peers, I mean, in Europe, in Japan, even in the United States, I mean, there's a real struggle on their part to begin to understand how to analyze these. Do you look at specifically national security interests? Do you look at international security interests? A diversified supply chain is inherently good for everyone. And the last point that I'd make would be about public goods. I mean, if you look at critical minerals, you can make an argument that even their extraction contributes to, mitigation of climate effects. It perhaps improves domestic tax revenues, but DFIs have always struggled with these kind of indirect routes to impact, not the least in kind of quantifying them. So there again, there are sort of particular challenges. So what makes a good critical minerals investment for a DFI is perhaps one of the thorniest questions that we're facing right at the moment. Hopefully I've given some flavor for why that's true. So thanks, Shahrukh.
Thank you, Colin. I think that's super useful, both indirect impacts, but also the commercialization and development outcomes, and then also these trade-offs around security and other things. Paul, I'm going to sort of close this round with your last words from you. Having sort of listened to this, of course, reflections on what others are saying would be equally welcome. But specifically, it would be great. Sorry, those who don't know Paul Collier, quite rare, is a director of the International Growth Center, one of the founders of IGC, and also a professor of economics at the University of Oxford, and author of more books and articles I can count, let alone read. So Paul, you've long argued about strong institutions before a boom hits, right? And if there is a boom here, and you say that often that they're key to avoiding a resource curse, can you reflect on what should governments be doing right now on the continent to lay the foundation before investment surge, assuming the investment will surge? Paul, you're on mute.
Here we go.
Perfect.
Charles, great question. Let me start with that word critical, and I want to say I really want to agree with Amir here that it's a loaded word, isn't it? It's a sort of panic word, and it's just a bit of sort of public relations at the moment. It's not a serious word. So forget the whole critical minerals bullshit, in my view. Sorry, that's a technical economic use of the word bullshit. Let's take a broader issue of when is it a good idea to extract natural resources? We don't know what's a critical mineral today, might be dead tomorrow, might be forgotten tomorrow, but we do know that Africa's had a very long period of digging itself up and selling its stuff and still dirt poor. So doing that is a bad idea. In the end, what Africa's short of and going to be desperately short of in the coming decade or so is jobs, productive jobs. What it's got is natural resources. So it's got to somehow go from natural resources to jobs. And we know that that won't be generated in the natural resources sector itself. As Colin Buckley's just said, natural resources sector doesn't employ anybody. Right? To a first approximation, it's massively capital intensive, very little labor employed, and that's how it is. So wherever you're going to look for jobs, it isn't in the natural resources sector. Forget that. Right? So what's the point of extracting the natural resources? To my mind, there's only one point: if the government can earn big money from it. vital thing is to win the struggle to get revenues. That means taxation, and taxation's hard. Taxation depends upon some effective institutions, and I think the word institution is a bit overworked. It's got to be effective systems of extracting the revenues. That's a myriad of different agencies that collect tax, but it's basically in that tax collection domain. And then what you do with the revenues, if you get to the fortunate position where you've got some, there seem to be two things that you really want to use those revenues for. One is to build effective cities, because cities that work are quite expensive. We've got a very good program at the IGC called Cities That Work, because most low-income country cities don't work. They get big, but they don't provide jobs for people. They're not effective places where businesses can do business. So building effective cities is an expensive process, but it's where you would put your money. And the second is you need educated people. So what's going to be the jobs that are future? They're going to be conducted in cities that work by people who have got some skills, some vocational skills. And Africa's been very bad at training people in vocational skills. It's got too many lawyers and not enough vocational skills, you know. Welders, bricklayers, think what you need to build an effective city. You need effective local transport, you need roads. These are technologies that we know how to do, but they need skilled people. So the vocational training that builds a pipeline of people who are capable of producing effective cities and then working in them for whatever Africa's going to be producing. For example, Africa's got loads of land. It's very unproductive land at the moment, but Africa should be capable of producing not only food to feed itself, which it doesn't do at the moment, it only gets about 40% of the food it eats is domestically supplied. Food production, skilled food production, requires a lot of sort of mid-level technology. A lot of food processing is about extracting water so that it lasts longer. These are very feasible things to do. So, just to go back to the big picture, extract the minerals only if you've got enough effective institutions to build revenues out of them. That's hard. If you haven't got the institutions there, be very hesitant about bringing the natural resources up. And then once you've got those revenues flowing in, then you think in terms of cities and skills. If we look around the world, there are lots of countries that have done that. Lots of them. It's just that we don't think of them as resource-rich countries anymore because they've moved on. Yeah, America used to be defined by a resource-rich country. It moved on from that. Chile used to be defined by resource extraction. 50% of all government revenues were from taxing one extractive resource until the 1920s. All the rents on that resource suddenly disappeared, and Chile was in a desperate state. Modern Chile completely rebuilt itself. It extracted copper, raised revenues from it, but didn't invest in copper. It invested in all the things that it's now doing, such as it's one of the major exporters of salmon in the world. Who'd have thought moving from copper to salmon would be a great idea, but it was. And that's because innovative people in firms thought of the idea and tried it out and learned. So that process of bubbling up from firms trying things, and for that you need finance for firms. So I'm going to close in a minute, but that's really, I would say I very much like the Zambia strategy that you sketched. I thought that was, skills for technology transfer, lower cost of capital for firms to actually set up and try things. I'm less keen on the sort of local value addition, as you'll have gathered. But I do like the sort of mutual advantage stuff rather than depending on aid. So I think Zambia scores 75% on my exam, which is pretty high. That's a first, right? Okay, back to you, Shah.
Thank you, Paul. Okay, so that's a great score. There's a lot here to unpack again, and I'm gonna encourage everyone in the Q&A, and a lot of people are already asking questions, to please ask questions so I can dilute accountability here and use you as my shield. I'm going to in a true Converse fashion, I'm going to randomize the order of the questions I ask everyone here. So just to keep everyone on the toes. But Amir, I want to start by you because you started with a very provocative proposition at the start. So I want you to sort of expand upon that a bit more. But coming from a perspective, like a very layman argument here, right? So if you are an African government, you have minerals, you do have them. There's a lot of conversation and some investment, not insignificant investment for a lot of African economies going into these minerals. I understand there's a lot of uncertainty, right? So there's technology innovations which could happen. Minerals may not be important anymore. It takes a lot of time, 10, 15, 20 years for projects to come online. There's a lot of things I have to factor, but there is an actual opportunity here. From this uncertainty perspective and your proposition, what is your advice to the government? How should they be thinking about this?
Thanks. That's a very good and provocative question. So, three things that I think government should consider on the policy front. First, really strong technological foresight to really understand what is the level of criticality of that resource, in which direction, where is the demand coming from, and are there any threats to that demand on the short, medium, and long term, right? So, for example, batteries. It's really not obvious which types of batteries will actually become the battery, right, in 10 years. So you want to hedge your risks. You might not, if I was a government, I would not necessarily want that much investments if I'm producing lithium or cobalt in kind of domestic battery manufacturing, because some of that might become obsolete, right, if solid state batteries take off. And by the way, Paul mentioned a very good example of Chile, where it was basically using nitrate, for most of its exports. And the reason behind this collapse is because of Fritz Haber. You might not have heard about this name, but he's the German scientist who figured out how to synthesize nitrate. So as he figured it out, basically natural nitrate, the value of natural nitrate lost its competitiveness. So that's why it keeps happening over time. So that's the number one. The number two is really take into account both the breadth and the depth of linkages that arise from the commodity. Copper, that we got a really good example, and it's really interesting to hear what Zambia is doing with a long-term strategy. The great thing about copper is that there are so many end users, right? So if you replace the use of copper in one technology, it doesn't matter. There are so many other products that you need copper for. For lithium, the linkage is deep but very narrow. So if you just disrupt that, if you substitute lithium for something else, then, it has a huge impact on its value. And then that can guide where governments want to go with a calculated risk, right? So they actually know, what kind of risk they're being exposed to, but they can design value addition industrial systems that can more easily adapt, right, if demand shifts from a product to another. The third one is the monopsony and monopoly concerns. And I think that's an important one to bring up here because of political and social pressures, when there's a discovery of a natural resource, there's kind of an expectation that this will be your engine of growth, right? It comes from a lot of hope, right? But when it comes to value addition, it's been really shown that it really depends on on how much of the global market or how much of global reserves you actually have. And that really defines the leverage you have for value addition. And I think Indonesia is a fantastic example. It's often bring forward in terms of the success story of the export ban for nickel. Great, it worked out great for them. What we often don't talk about is that when they imposed this export ban, it was not just for nickel. It was for other commodities, including bauxite. And it was an absolute disaster for bauxite. Why? Because you find bauxite everywhere else, right? You don't need to go to the Indonesians for bauxite. So no one wanted to invest in Indonesia. For nickel, it's different because they hold a large share of nickel reserves, and the Chinese end use was actually calibrated for Indonesian nickel grades. So they had leverage, right? So that's the really last important consideration, leverage, and when is it worth it to try to add value. So these, I think, would be the three main considerations, but the kind of summary of it is, the real critical resource on the African continent elsewhere is not in the natural resource, but it's in the human resource, right? It's the human capital, it's the skills. And therefore, those resources can only be a real engine of growth if and only if they're part of a much broader development strategy. And then you understand what is it that they can deliver, what is it that they won't be able to deliver, but also what else do you actually have to do. If it's just a one-off, this is when you expose yourself to a lot of the risks that were mentioned earlier by Paul and others.
Thank you, Amir. And someone asked a question about, why African countries don't just ban raw exports outright, like Indonesia in the chat book. So I think that responds to that very well. I'm going to start integrating questions. We have about a dozen of them already in. So Kuso, I want to come to you next. And I have two questions. I'm sorry. The one is from the audience member and the other is from me. So my question is this. There's a lot of, from a national government perspective, when people see minerals, not physically, but like when they see that they have mineral resources, they see conversations happening that these are really, really critical to whoever they might be. These are worth X amounts of billions of dollars under the ground. And they see sometimes investments happening, right? They see all of this stuff, but the big problem for governments is often managing expectations, as Paul and Colin and others were saying, that often they don't result in mass job creation. It will take decades for them to come online. Most benefits are tax benefits, and non-tax benefits are really hard because value chains and supply chains downward, upward, sideways are quite limited. There's often serves as an enclave sector. How do you, like sitting in that seat, how do you think about this expectation management, and what is the strategy here? What have you learned? What is working? And any thoughts on that would be great. Related to it, somewhat, there's an audience question about the effects on land rights and other forms of rights for people when we think about critical minerals, and also your reflections on that, but I think sort of they link together neatly.
Okay, thanks, Shah. I think I can link the answers to both questions. Of course, as government, it becomes difficult to manage the expectations of the locals. I think the first thing that we have to understand when it comes to issues of local ownership, land rights, is that the nexus between the land rights and the extractives is definitely anchored on the social contract that has to be made available. We need to understand that there is a role that the traditional leadership plays, and this must be respected by the investors. When you enter a specific space to commence mining activities, whether it's exploration, we have to be mindful that there is traditional leadership in place, and there is a community that existed before the investor came. And so it's imperative for companies to then be conscious of this role and make sure that they are providing a social license that is mutually beneficial and makes the traditional leadership and the community comfortable, because they will need these communities to be comfortable for them to operate comfortably in that particular environment. So definitely we have to look at those social contract issues that are in place. We also have to consider that there has to be some kind of belief that there is equitable sharing of benefits. And sometimes as government, we find ourselves stepping into this space to assist if, let's say, the investor and the community or the traditional leadership are not able to agree on a matter, or maybe there's even just issues to do with a barrier in terms of understanding. We have supported such engagements in the past. But more than that, we're also looking at seeing how we can formalize the operations of our local and artisanal miners. We just recently issued over 500 mining licenses to ASM miners, the small-scale miners. This is also just an effort for government to assist them to do their operations legally, to make them feel included, and to really just support the mining activities for the locals as well. And I believe that local formalization goes beyond just us licensing these people. We're also making sure that we provide support and safety and geodata and everything that they need for them to operate. So we have actually, as government, created a special unit in the ministry, which is looking at ASM, which is artisanal and small-scale mining. And these are some of the efforts that government is making to make sure that we make the locals feel involved, and that is definitely helping. So the other issue is that we feel that there's also been some kind of delinkage between the mining sector and the rest of the sectors. So we have also tried to come up with, some local content regulations to ensure that the locals are also participating in the mining value chain. So this encompasses both downstream and upstream activities. So I feel as if, yes, there have been mistrust in the past and, feelings of we're not getting enough from the minerals. But with the efforts that we're currently doing as the new Dawn administration, the public is able to see for the first time, some of them have licenses for land that they've trying to operate on for a very long time. So I think issues of that, slowly we are beginning to build a very trusting relationship between government and the public, and also with the local leadership. We've been able to bring them on board. After all, they do have land rights as well. So yeah, there's a lot that's happening, but I think it's testament in the laws that we are bringing on board. We have partnerships with the EU and others that are helping us formalize these sectors and really just include the locals. So from a government perspective, I would have loved that you asked them the same question, but I just feel that a lot of Zambians are now beginning to understand that nobody's ripping anybody off. If anything, in the foreign mines that are operating in Zambia right now, all of them, there's no government money except one, of course, which is CNMC, which is also partly owned by their government as well. But with the rest of the foreign mines, there's no government money that has been funded. The locals are able to see that this is foreign money being invested, creating jobs, creating value. And I think in terms of negotiations, we've been able to negotiate deals that as high as 49% to 51% where government gets involved. So I'd like to believe that the efforts that we are making is really building the confidence in our locals. I have a few Zambians online. I hope they can attest to this as well. Thank you.
Thank you so much. Okay, so I think that great thoughts about this, and it's a difficult trade-off. Colin, there's a couple of questions coming towards you, and they all tend to sort of circle back to this same thing, which is that feasibility studies for critical raw minerals is where a lot of financing doesn't happen. And that is sort of a core constraint, a lot of people in the audience say, is for leading to expansion of CRMs, critical raw minerals, on the continent. Can you reflect a bit about sort of that first stage of the project, so that feasibility side, and what can DFIs are doing or could do more to help alleviate that constraint?
Yeah. By the way, there's a fire alarm test in the background here, if you can hear that. So sorry about that. I mean, look, DFIs can fund feasibility studies, and they and the World Bank and the African Development Bank have been doing these for years. But really, the particular opportunity here is, I mean, as Paul says, Africa needs jobs. But if there was going to be something else they need more bankable infrastructure projects. And one of the unique opportunities we have here is that governments can get mining companies to basically sponsor transport infrastructure projects. I mean, it would have been unheard of for anyone to talk about the possibility of a rail line going from Zambia across Angola, or a line going across northern Mozambique. The only reason these are being spoken of is because you have mining companies that are willing to front the development and feasibility cost of doing that. So, I mean, that is a real opportunity of African governments using this as an opportunity to get infrastructure built that will survive the perhaps transitory critical mineral and can be used for broader economic growth, because that's clearly something that most African countries can use. So I think it's not so much DFI feasibility studies we can do it, but it's actually turning a feasibility study into a project. And I think governments can insist that mining businesses do that.
Great. Thank you so much, Colin. Marit, I want to come to you for a question which has been asked by the audience member. And that's partly, I think, a sort of result of the changing development landscape globally and sort of aid cuts, and that has impacted how the development sector and aid to a lot of African country functions right now. And recently there was a summit in Italy, which critical minerals were a big part of it, and there's a plan as a result of it, I think, by the Italian government. It's called the Matai plan, if I'm pronouncing that correctly. The question asked is that the changing aid landscape, the sort of more focus by a lot of global North countries, quote unquote, G7 and others countries focusing on critical minerals. How do you see the partnership between the continent and sort of G7 and other richer countries shaping? Is it becoming more partnership of equals?
Yeah, thank you very much for that question. Before I answer that one, I just want to, I mean, there's a fundamental difference of approach between what Sir Collier said and what we are advocating, because it's true, revenue is important, but it's what we realized since 16 years since the Africa Mining Vision. There is not the optimal way of getting financing for Africa through minerals or through any other sectors. So that's why we opted for value addition and for creating value on the continent through, and that, of course, the first part, the exploration, does not create jobs, obviously, but the spin-off, the next step, value addition, because we're not only thinking, there's linkages, and I'm glad Kuso talked about it, linkages, local content, the suppliers, all of these suppliers, there's a boom that gets created around the mine, not just in the downstream, but also in upstream. And you can create so much ecosystem around mining. If it's done correctly, then you can, instead of a vicious cycle, you can create a whole boom. And it does, we do have, and I don't know why Indonesia, I'm glad Amir talked about Indonesia, is a very good example of nickel gone right. Chile also at some point they had value addition. That's when they diversified into salmon, which is another. We can come to that stage at a later stage, but if you want to create real value on the continent, because this was rooted on colonialism and extractivism before, and everything was done for the West. I mean, if you see the railroads, it's like a spider in Africa. It's all meant to go outside. So we really need to look inside, and value addition and resource-based industrialization. Morocco is doing a very good job. I don't know why these examples are not. South Africa does also some. I know Zambia is doing, but not. Zimbabwe is another example. It went to deindustrialization right now. But the point I'm trying to make is that if you really want economies of scale, if you want to transform your economy, it's not just going revenue, because 80 billion every year is going. It's more than any ODA through illicit financial flows, transfer pricing, all of these deals that they have. So the point is that I thought we moved on from this conversation 16 years ago, that, it's not enough just to get the revenue, because it's to get the strong institutions, to get all of these things. It's not just, but what we need is that making sure that we relate it to the other sectors, like Zambia was telling us. industry mining complex with others, like the military complex, industrial complex that other countries are doing. And for that, again, we need deliberate. It's not that we do not know, but we really need cohesive policies, and that's the surest way. Botswana is a good example. Morocco, in South Africa, others are coming up. We are hoping Zambia will be one. DRC is complex, but we are also hoping on DRC. On the Matei plan, I think it's more of an energy, but in general, like we say, now we have this Africa Green Mineral Strategy. It took us a long time to have it adopted. Very happy that it was adopted. Finally, we started on this before the EU Critical Mineral Strategy, before any of it. And strangely enough, the EU Critical Strategy looks very much like the Africa Mining Vision, but it's about localizing. It's about supplying, making sure that you disrupt the supply, not to China. So we are all in the same. When it comes to critical mineral, we are all in the same place. Like no one has the really technology except China. So we are all in that race. The point I'm trying to make is that we do have the minerals on our soil. That gives us very big advantage, 30% of the reserves. And Africa is very much underexplored. So we really need to be focused. And talking about partnership, we have to be on I don't even like the word win-win, because we need equity as well. But at the end of the day, we have strategies, we have the vision, and this green mineral strategy is very specific. It tells you what you need to do. It's not a pipe dream. For example, if you want copper, what you need to do and where to get it, what kind of energy you need, what kind of skills, technology you need, where you can source it, how you can do joint ventures. Is very elaborate, very specific. And then you have to, of course, drill it down to countries. But, it really needs some kind of approach that is focused, deliberate, and the partnership. We are not into this geopolitics in Africa. I mean, we have a strategy. If you are China, if you are Korea, if you are Saudi, because nowadays it's everyone. US is coming as well. We have the strategy. If you are if you do the value addition and all this also responsible, I have to say, we have to take care of the environment, displacement of people. I don't want to forget that in this conversation, but we have it in writing. So what we're saying that is that it doesn't matter if you're a US or Saudi or UAE, it's just you have to abide by the Green Mineral Strategy. And Colin was making very good points about the financing. Well, there's DFIs. There are also the Afreximbank. Now we have African DFIs. Afreximbank has done a very good job in the specialized economic zone for this DRC that we're talking about. And the pre-feasibility studies done by Africa Finance Corporations, so what I'm saying is we do have also DFIs in Africa that we need to and again, we were not really talking about the perceived risks, but those are also something that are holding back investment. So we have to work on those. And we have also other mechanisms in Africa that we have developed, which is a classification, Africa Minerals and Energy Resources Classification, and the Pan-African Resource Code that can leverage these minerals reserves in a much more transparent way to capital markets to acquire some African capital. But it's a bit long said. But what I'm saying is we're really trying to put together all the tools so that we can really push for this. And it's not just about revenue, because, even if you see this value chain of battery, the Bloomberg study found that if you just focus on the first phase, if it's just extraction, you get 11 billion out of this revenue, which it could be decent for the DRC. But then if you go up to the precursor, which is without the anode, is the NMC, nickel, manganese, cobalt, you already have 271 billion. If you go up to the battery itself, 7 trillion. I mean, we're talking about exponential ones. So why should we just focus on the first phase and then wait until we get to and about the jobs, like I said, if it's done well, you can have all these expansions of, even sideways, even infrastructure. We get workers for infrastructure, you get jobs, maybe not. And then, as Amir was saying, if you focus on in technology, everyone is looking for technology, you train your people. It's not just vocational. Vocational is one, but the R&D and innovation. Of course, vocational is important, we agree, but you don't transform through vocational training. You transform through research, development, and innovation, real skills, like very specific skills. Thank you.
Thank you so much, Marit. I think incredible interventions and also building up on what a lot of other people in the panel have said. Paul, I'm going to come to you in a second, but after Paul, 1 minute closing takeaways from everyone, maximum 3 things, going back to the question we started with, the premise we started with, the economic development opportunity here for Africa in critical minerals. 3 things you want to take away. So I'm going to come to everyone after Paul. So Paul, there's a lot of questions. Of course, Marit has also proposed some sort of thoughts on what you were saying, and reflections on that will be very useful. But a lot of people are saying that to build or expand upon what you said before, and to clarify your view, you're saying one question, for example, is that the value addition in country does not make economic sense. Is that the argument? What would you suggest that this is exported in its raw material from existing processing countries to existing processing countries and just capture tax benefits? So, Paul, expanding upon questions on what you would suggest countries with these mineral resources to do, who might not have sort of the institutions in place, or and also reflecting on what others have said on the panel. Paul, you're on mute.
There we go. Okay, it varies between the minerals, but let's take oil, which is huge, right? Should Africa produce oil if it's got it? Of course it should. Right? America's president is busy saying drill, baby, drill. So whilst he's doing that, I don't see any reason why Africa should not extract its oil if it can find it and extract it. And of course, oil doesn't produce jobs directly, but it does produce a hell of a lot of revenues. Should it be refined? No, it's a hugely capital-intensive process, refining. It's a complete waste of time. Pretty well every Gulf state, which is awash with capital, the opposite characteristics from Africa, every Gulf state put its money into refining. So of course it makes sense for Africa to extract the oil, take it in its crude form to the Gulf, which has got abundant capital and few people, and so you get it refined in the Gulf. That's okay. So gas is very expensive to transform into LNG, to liquefy it. And there it's best to do that cooperatively with us. For example, Tanzania, northern Tanzania, and southern Tanzania and northern Mozambique both have pretty much the same gas field. It's very sensible if they could share a single what's called a train, which is the enormously expensive bit of apparatus that liquefies the gas, and then sell it on the world market, which is huge, again, hugely valuable. So both these two big things of oil and gas, there's some scope for, as I say, with gas liquefying it, there's some scope for cooperation and doing that on the continent. With oil, you really just want to get it out of the ground and sell it. So then it moves on. As Amir was saying, the great thing about copper is it has got many different uses. So it's fairly robust against future technological changes. Can you do in Indonesia? Well, again, Amir was very sensible there that it depends upon whether you've got an OPEC-type monopoly, which seldom do you have. You've got some scope for trying to exploit that, but it's really dangerous. I mean, Ghana used to, let me think, no, Nigeria used to have a big trade in cocoa, which then shifted to Indonesia, which didn't have any. And now cocoa's got the industry, and not Nigeria. So these attempts to exploit monopoly positions are quite dangerous, I think. The scope for new entrants is always there. I come back to the point that really it's more important to diversify than anything else, and the diversification is expensive. It means things like cities and things like skills, and that's Africa's future. It's got a huge number of young people coming on the market. And young people are a huge resource if they're given the opportunity to be innovative. What young people are really good at is adopting new technologies and adapting them. The great powerhouses of firms, which is South Korea, Japan, Germany, they've so messed up their demography that they're running out of young people. They've got the firms, and Africa's got the young people. Should the young people go to where the firms are, or should the firms go to where the young people are? Obviously, the firms should go to where the young people are. And so Africa's role is to try and build platforms where the firms can function. And that's a huge opportunity for productive jobs for young people. You won't find that many productive jobs for young people in the natural resource sector. You just won't. Right? So that's my 2 minutes, I guess.
Thank you, Paul. I might come back to you. I know we have run out of time technically, but if everyone is okay with having 60 seconds per person, final takeaways, religiously sticking to 60 seconds. Amir, I'm going to come to you first, Kuso, Marit, Colin, and then Paul. So Amir, over to you.
So 60 seconds to close.
Yes. What is your takeaways?
So the takeaways is that, well, the reality is complex, that criticality must be carefully unpacked, that governments must have ownership of the agenda to be able to justify, the long-term strategy. But maybe one thing that also comes to mind, I'm not sure if this is the desired conclusion, is tolerance for failure. It all looks so complicated that it's okay to try, fail, learn, and adapt accordingly. So value addition strategies must have embedded institutional mechanisms to correct, adjust, evaluate, and change the strategy accordingly, given that markets are changing, regulations might move, technologies might get disrupted. So as countries like Zambia embark on this, it was really insightful to see that there is a vision, but at the same time, there is room for adjustment over time. And as a friend once said, having a vision is good, but too many visions can lead to hallucinations. So it's good the execution matters. Thank you. Thank you for a good discussion.
Thank you, Albert. Thank you for joining. Kuso?
Okay, I'm gonna have to be looking at my timer. But 3 key takeaways for me, Shah. First of all, thank you for having me. It's been busy, but I made sure that I was here for you today. 3 key takeaways for me for Africa. It's invest, invest, and invest. Africa must invest in its people, skills, and technology. If you look at the gaps that we have between what the industry requires and what we are producing out of our colleges and universities, the gaps are huge. And so we must invest in our skills and our technology. Two, we must invest in value addition, regardless of what Paul says. I just feel that as Africa, we must continue to strive to move up the value chain. Exporting raw materials is no longer enough. The more we export raw materials, the more we export jobs. So let's just look at how we can invest in local processing, refining, and manufacturing. And lastly, again, Africa must invest in strategic partnerships. When we say partnerships of equals, it shouldn't just remain at that. It should go beyond words. Like, what are we talking about exactly? We must invest in conversations, and we must invest in de-risking our projects. We must invest in crowdfunding if we must. Let's look at our pension funds. Let's just look at all the unconventional ways that we can raise financing. So for me, the key takeaway is that there's still a lot of work that needs to be done. We have to continue investing. We cannot extract milk from a cow that we are not feeding. So just an encouragement to say, don't be discouraged by the multiple conversations happening here today. We must continue. And I think that in the next 10 years, we're definitely going to see a huge turnaround in terms of getting value out of our minerals. Thank you.
Thank you so much, Marit.
I'm going to say what she said because she said most of the thing I wanted to say. But yes, definitely. I mean, value addition, benefit sharing, and diversification are key when it comes to critical or non-critical minerals in general. Otherwise, we lose value. That is a settled question for Africa since the time of the Africa Mining Vision. And to do that, we need stronger partnerships. And talking about stronger partnership from within the continent, regional collaboration, and deliberate. I keep saying deliberate because there's no invisible hand here. We really need deliberate policies and togetherness and harmonization of policies. Zambia, DRC, Zimbabwe, and even Gabon and Nigeria. Otherwise, if we do not, then there's always a race to the bottom, because if we rely on they will pitch a point where which one offers better and what not. And the third one, as you said, is capital. The capital. We really need to put our acts together. This Africa Green Mineral Strategy put a venture capital fund, and the way it's going to be structured, it's approved by the member states, so it will come. It's going to be structured. It's still up in the air, but DFIs can contribute, mining companies can contribute, and also governments. But we really need a fund, because at the end of the day, we'll be just talking if we do not have concrete ways of implementing our visions and strategies. Thank you.
Thank you so much, Colin.
Yeah, sorry.
3 takeaways. First one, from a development point of view, the best deal for African countries is probably supporting infrastructure. Second, there are fundamental trade-offs amongst return, development, and security in this space. And the third one is, we should respect African government decisions to promote extractives. Extractives are better than nothing. They do create revenues. They do give government the resources to do public spending. So we really should not entertain the thought that this is a no-go space. And I'll stop there.
Thank you so much, Colin. And Paul, the final word.
Can you unmute?
Yeah, you're unmuted.
Okay. I wanted to end with a simple thing, which is how governments can manage expectations. It's very hard in any country. Africa's no different from Europe here. When people hear the word a million or a billion, these are dizzying numbers. And so I always translate into how much per person per month. Most people on Earth think in terms of something like a monthly income. And so by just expressing these natural resource money in terms of how much is it per person in the country per month, and it comes down from dizzying numbers often to really quite small numbers. And that's the really simple way of deflating the expectations. We're rich, we don't have to work anymore. So on that note, a simple point, but good communications between a government and its people. Without that, nothing's going to work.
Brilliant. Thank you so much, Paul. Thank you everyone for joining the conversation today. Thank you for Oliver and the team at VoxDev for helping organize this. Follow VoxDev, follow the IGC. There's a lot of material out there in research and work on critical minerals, but also please look up everyone on the panel today. Everyone is doing incredible work and will be a lot to learn. I'm sorry that we couldn't get through all the questions. There were about 24, but you can reach out to anyone by email and ask them questions. I'm sure everyone would love that.